People talk a lot about what a stock is really worth, but what is the most important thing to think about when determining stock prices? Warren Buffett has said in multiple interviews that the most important item over time in valuation is obviously interest rates. I'll include a link for the article that says this in the description. But why would bonds have anything to do with stocks? Aren't they two different things? Well, yes, clearly they are different, but perhaps I can explain why they matter. There's a common old saying that a bird in the hand is worth two in the bush, and what this means is that it's better to hold on to something that you have than to risk losing it and trying to get something better. And this is where things start to connect. But before we get into bonds, let's get into something that might be less distracting and might confuse people. Let's just say that there are two choices. Number one, you deposit $100 today, and in 1 year you get $105, so a 5% return. It's something that you know about. Whereas choice number two, you deposit $100 today, and in 1 year you can get anywhere from $90 to $120, a range of negative 10% to plus 20% return. Choice number one, that's your bird in the hand. You're pretty sure you know what you're going to get, and it's honestly not a terrible return, but not amazing either. Whereas choice number two, you can get better than 5% returns, but sadly you might actually lose more than you started with. And this is your two in the bush choice. That example was actually pretty fair. One that people could honestly debate whether it would be worth choosing one versus the other. But let's just tweak the numbers a little bit. Let's say that once again there's two choices. The first is you deposit $100 and after a year you get the $115, so a 15% return. Versus choice number two, you deposit $100 and in 1 year you can get anywhere from $90 to $120, a range of negative 10 to plus 20% return. Now wait a minute. Why would anybody choose option number two? The chance to make a tiny little bit of extra 5% doesn't seem worth it given that I could also be losing my money or not even getting the full 15% in the other option. The guarantee of 15% is very convincing and it makes option number two seem significantly worse. So now that the point of the guarantee versus the non-guaranteed point was made, let's get back to interest rates and stocks. Bonds are seen as much more stable forms of investment. They get preferential treatment during bankruptcies and have predictable payouts that people can rely on. Most notably, the yields from extremely stable bonds, such as the US Treasury bonds, are seen as one of the lowest risk assets that a person could ever buy. And this, of course, is our bird in the hand. Something stable, like the US Treasury bond, is so stable, it's almost seen as a guarantee to some investors, and they use this as a benchmark to make value decisions. Let's look at some of these rates today. So when you see incredibly low interest rates coming from the US Treasury, getting your hands on a 1-year note means you can lock in an incredible 0.09% yield, which is stunning. I know you're all interested in getting some of these lovely government bonds, and they are available through the government's official portal at treasurydirect.org. So as you can probably summarize, the place that they would rather choose is likely stocks, even despite the setbacks caused by world events in 2020 and the notable volatility. This shows the PE ratios that people are willing to purchase these assets at. Sure, it's not a bargain in most cases, but the alternative isn't that great either. So even though we're at really high ratios that people are willing to purchase these stocks at, by comparison, the interest rates are so bad, they're willing to pay up more for them. Going back to our examples, this means that in today's environment, using the Fed's 1-year bond, we would get approximately a 0.1% return. And this is our current bird in the hand. And that doesn't even match inflation. And yes, you could say that you could get into the 30-year note, but that one also is less than 2% returns. Alternatively, we could hope that stocks outperform. But given the economic situation, this two in the bush scenario isn't exactly compelling either. People aren't really sure about the stock market due to pricing combined with the general economy. I'll just give this a rough negative 20 to plus 20% outcome because no one seems to really know what will happen. So going back to Warren Buffett's statement of valuation being primarily based on interest rates, we can see why this holds true. The known returns coming from bonds has an incredible amount of influence on whether or not stocks look attractive. Please subscribe if you enjoyed these finance videos. I make all kinds of topics that I think people can learn from and find appealing. Thank you so much for watching, and I hope to see you in the next episode.